It is now time to welcome our first keynote speaker for the day. With all of the constant but ever-changing upheaval in our global environment, there is simply no one better placed to speak on the risks facing all of us and how we can hope to navigate our way through them than Vice President and Chief Risk Officer for the World Bank Group, Lakshmi Shyam-Sunder. Please join me in welcoming Lakshmi to the stage.
Thank you very much, Anjali, and thank you very much to the Governance Institute for having me here today. I suspect I will learn more from you than you will learn from me, because what I'm going to tell you is something you probably see all around. But from where I sit, I enjoy these trips because it opens my eyes to things that I may have not noticed where I sit in Washington for the most part. And I'm particularly thankful to the Governance Institute for inviting me today. And as I was telling somebody, I didn't realize there was an institute dedicated to governance issues. Because if you think back to risk management and how it has evolved, the heart of good risk management is really good governance. It may have started off with very technical assessments of risk, measuring risks and returns, especially in finance, but then evolving into broader and broader areas like operational risks, non-financial risks, for the World Bank, risk to our development outcomes and what happens in our client countries. But when you put it all together, what really matters is how do you approach this? How do you decide who's responsible for what? How do you make accountabilities clear? And lately in my life, I've been spending more and more of my time on governance type issues. So Anjali and I will converse a little bit after I do my initial few remarks on some of the governance issues that we all face. It's softer stuff, but I thought I'd begin with a general backdrop of some of the issues we are all facing as we try to do our job as risk managers. Again, if I look back at my career, I think I've been at this now for some decades, starting from very, very junior levels. But if I look back, I think the job was much, much easier when I started. And even over time, even as the field evolved and branched into newer and newer areas from finance and so on, we were dealing with a world in which I think we could count or rely on certain structures. There was a structure around the world. We knew who the players were, what their roles were. We knew what monetary policy was. We knew what fiscal policy was. We knew what levers to press. And we knew if we pressed them in a certain direction, we could predict certain outcomes. Sure, there was volatility, there was noise, but that was still risks we could manage. What we face in the last, or have been facing, I would say, in the last few years is somehow a breakdown of that structure and those relationships. Everything seems to be shifting under our feet. And in this situation, I think it's perhaps less meaningful to call this risk management than really how do you deal with what I'm going to call an uncertain environment. And you know, an uncertain environment is one which you don't know what's going to happen, and it's somewhat meaningless to attach probabilities to outcomes. We really have to be more agile in thinking of scenarios and then being prepared to deal with those scenarios and adapt as and when certain outcomes occur. And we don't know what the new equilibrium will be, nor when it will happen. All we know right now is we're in the midst of some very, very fundamental changes. And for me at the World Bank, this hits very close to the center of who we are, because we were created after the war, World War II, as part of the Bretton Woods institutions, and that was a certain world order that we inherited. And this whole structure was built on that. And I do remember for a long time actually, even now, we have this classification of countries as Part 1 and Part 2 countries. And Part 1 were the shareholders in these institutions. They were the providers of capital. And Part 2 was where we operated and where we lent money. And you know, our whole goal was bringing the Part 2 up. And for a long time, that is exactly what was happening. And we saw these two converging to some degree, and we thought they would converge. What is now happening really is much more splintering of all of the countries. And the convergence that we thought would happen doesn't seem to be happening, both economically as well as politically. And this is creating fundamental shifts for us. And we see this in dynamics of the board as well. We could count on certain players saying certain things or wanting us to do certain things in a certain way. That is changing dramatically, and the relative power dynamics in our board is changing quite significantly. This is both risk, but it's also an opportunity, because it means now we can have some players who are perhaps taking a back seat contribute more and play a more positive role. So we're trying to wrestle with all of these things at the same time. And what I thought I'd do is perhaps outline some of these changes that we're seeing about us. This is not exhaustive by any means, there's too much going on, but just to hit upon some broad sources of uncertainty. Some of it has to do with monetary and fiscal policies, some with geopolitical risks, some with the macro environment and the increases in debt, but also the dynamics of that debt. And of course, very importantly, and probably for this region, something you are all much more expert on, the trade wars that are going on and the discussions and the implications for countries in this region. And finally, some concluding remarks before we move into governance issues. So first, looking at global uncertainty, we all now are able to measure actually the indications of uncertainty in the environment. And just one of these indicators is on your left-hand side, which is the Global Uncertainty or Policy Uncertainty Index, which you see is sharply rising in the last few years, particularly in China and in the US, and globally as well. And interestingly, we also find a flight to gold, and gold prices increasing. This is happening also because in times of uncertainty, that's the normal hedge that people move to. And there are all sorts of stories of people moving into gold for a variety of reasons because they fear what's coming. If you move into monetary policy, I think probably the big shift occurred after the crisis or at the time of the crisis, when most of the developed world and some of the developing world as well acted in concert to deal with the aftermath of that crisis. And there was a massive loosening of monetary policy, cuts in interest rates, and unconventional methods like QE and asset purchases. Now, I should say, I think there have been some studies done on this, and the overall consensus is these stimulus measures actually worked. And they did put the whole global economy back on track to some extent. There have been recoveries, and in the US, it has been quite successful. Unemployment has dropped dramatically, and it has had one of the longest recoveries that it has ever seen. So that's, in the UK as well, you see good effects. But what is troubling people now is what does this mean for the future? First, there's the unwinding of all the asset purchases and the destabilization that could have. Second is how low can interest rates really go? And more and more the concern is we've gone about as far as you can go. Yes, technically you could go even lower, you could go into negative rates, but it's not having any more effect on the economy. And what do you do if you really have to do something if things worsen? You have no more room to do anything. So this is a big concern. And you also, another thing that people are worried about is a divergence across countries. So there's a bit of a beggar thy neighbor type of policy with everybody competing with one another, less on the interest rates itself, but more spilling over into implications for exchange rates. And there are some people who liken this a lot to the environment that prevailed at the time of the Great Depression in the 30s. That's quite alarming if that's what we're going to see happen. And this will be something most of us in this room have not experienced and don't know how to deal with. So that's something we should be looking at. The other fallout of this is uncertainty about immediate measures. We just went through in the US a period of tightening of credit. And all of a sudden there was a change in signals which said, well, there's going to be a rate cut. And the market immediately reacted and expected more and more rate cuts. So you have this very strange dynamic where, the traditional textbook version of the Fed is the Fed sets market expectations. And it has to be a credible Fed, and that's why the market believes what the Fed is going to say. What is going to do. However, what we're seeing now is more like the Fed reacting to the markets. And the market is setting the tone and the expectation, and the Fed is then responding to that, which is a very, very perverse sort of thing. The Fed seems to get nervous if markets get more volatile. Well, if there is going to be a recession, we've had recessions in the past. Why are we so nervous about a recession? That's capitalism's way of dealing with issues. But we seem to be extremely nervous of even a small or modest recession. And maybe because we fear something catastrophic, and so we don't want anything like that to happen. But we're running out of ammunition. The other thing is there is much more what's called forward guidance given by the Fed. And also members of the Fed talk freely, much more freely than I used to in the past, and often give confusing messages. All of this is unsettling markets quite a bit in the US and elsewhere as well. Another thing you see, there's a loosening of the monetary stance everywhere. I think even in Australia now interest rates have been cut. Other countries have all followed the Fed and more or less are reducing interest rates. But there is also in many countries, not just in the US, more and more a questioning of the independence of the Fed. Academics, economists, people in governance will say the Fed needs to be independent. But you see many countries in which there is pressure being put on the Fed to act. Whether it's related to political cycles or other factors, we don't know. Most likely it is related to political and election cycles. But you see this pressure happening more and more. Again, something we all lived with and took as an axiom was the Fed was independent. And that seems to be weakening a bit, at least in expectations. Then you get to fiscal policy. Again, here it's extremely unclear. There have been massive stimulus packages, but the interaction between monetary and fiscal policy is not clear now. What is doing what? Is monetary policy taking on the role of fiscal policy? There have even been cases where the central bank is talking now about buying sovereign debt. And these are all very, very unconventional things that, at least in the time I managed risk all these years, we didn't have to deal with these sorts of issues. There is also less and less fiscal space. Not so much in the advanced countries, but certainly in emerging markets, much less fiscal space to use fiscal policy as a tool for stimulus. Now we have in the US some more talk of additional tax cuts. Australia has tax cuts in the works. Germany is talking about some stimulus packages on the fiscal side. So we have to see how all of this interacts with monetary policy. Finally, not finally, but let me move on from this into geopolitical risks. This is something we're reading about in the newspaper, so I won't get into each of these in detail. One is, of course, trade and protectionism. And this is not just US-China. It's certainly other bilateral relationships as well, where people are getting more inward-looking and more competitive about how they should address these. Korea, Japan is an example. The risk of Brexit and what might happen without a deal, which is very, very proximate risk now. Tensions in the Middle East. Again, it's not just the areas of conflict, but there's also the whole issue of Iran, where there had been some kind of pact, some kind of agreement, but that seems to have weakened, and it could have all sorts of implications that are quite unpredictable. Closer to home here in this region is what's happening in Hong Kong. Now, in '97, there was a very peaceful transition, and I think people who were nervous at that time probably left and went. But ex post, things worked out very well. And now, all of a sudden, you see that what we took for granted as a place that was very well functioning, we're seeing some significant tensions. I should say in the bank, we operate in some of the riskiest countries in the world, but we also have offices in places like Hong Kong, Singapore, and so on. And we would have classified these as the safest places, where we really wouldn't worry about things like terrorism or violence of any kind. And I don't think our staff are prepared, frankly, to deal with any event that would occur there. We don't give them as much training. They're pretty casual about their lives. Whereas if you operate in Yemen or Iraq, I mean, you are put through the greatest security training. You would go to CIA-type courses and learn everything you had to defend yourself. So you just see the difference in how we treat staff. And that is making us rethink now. Some of the areas that we thought were very safe, we have to rethink how we are approaching these from a business continuity and security standpoint. Then you also have things happening in Italy. And in emerging market countries, I think many of our client countries are going through election cycles this year or the next, and you see all the turmoil associated with that. A very, very recent and noisy example is Argentina. You just had the first round results, and you see the turmoil that resulted from that. He has not yet won the election, but you can see how the market has reacted to that event. And underlying all this is a sense of nationalism. I mentioned this earlier, but this global order of collective problem solving, attention to global public goods, that seems to be breaking down. And it's more, I need to attend to my own country's needs first, the issues that I am facing. And some of those are economic. Globalization certainly left some sections of society worse off rather than better off. And that's something I think everyone bears responsibility for. It wasn't something anybody anticipated, but that is a direct consequence. A second is the effect of migration. Again, it's linked to all that's happening in many of the developing countries, and the lack of opportunity there is also, there's partly war and conflict, but there's also lack of economic opportunity which drives migration. And there is limited capacity in the developed world to absorb this volume of migration. So you see that tension very, very strongly in many of the countries. And what does this all mean for the global macro environment? Every 6 months, we put out our global economic prospects, where our economists really, they try to digest all the information, but also put it into their standard models and try to come up with estimates of growth. And the most recent estimate is a downward revision in growth forecasts by about 0.3% for the US and advanced markets. But globally, you will see growth going significantly lower. And I suspect if further revisions occur, they're likely to be on the downward side rather than the upward side. And some of the projections that you see on the screen, I won't go through all the numbers, but they are based, they do take into account the trade difficulties and trade negotiations taking place, but they are based on an assumption that this issue will be addressed. And if our economists, I was talking to them, they assign a 20% chance that, in fact, this may not be addressed, in which case growth could be even 1 whole percentage point lower than what's shown here. That's quite significant in terms of global GDP. Moving down to where this is going to happen, it's going to affect all countries. It's not just US, China, it's global. And you see some of the signs happening for us among our client countries as well, Argentina, Turkey, as well as commodity exporters, Russia, Venezuela, Mexico is having some significant problems. Oil prices, which usually are good news when oil prices go up for many of our client countries because they're mineral and oil exporters, but oil prices are predicted to be quite stable, as is inflation, which ironically for many of our client countries means they will not have much fiscal space to do the reforms, and if something happens and they need to borrow more, much less ability to sustain that debt. And this brings me to debt developments. After the crisis, there was a fair amount of deleveraging that was occurring. And I think in the US, it is fair to say that the banking sector has actually done a very good job deleveraging. That's not necessarily true in other parts of the world, where leverage actually increased. And if you look purely at government debt, that has actually gone up in the advanced markets, but also in emerging markets. And we are having a serious debate about what this means and whether this is good or bad news. On the one hand, there are some people who say, look, yields are extremely low, and this is a good time to borrow because the cost of servicing this debt is much lower, so it makes sense for our client countries to borrow at these rates and build up the reserves they need to make productive investments. And I think that's true if all of that money is used for actual productive investments. But that, unfortunately, is not always the case, again, because it's linked to political cycles and populist measures, which in the end means they cannot repay the debt. And where we are particularly concerned is some of our lower income countries. You might know that we have a concessional arm of the World Bank Group that lends at very, very low rates of interest, or actually sometimes even grants, but often loans, at a cost that is just something that covers our administrative expenses. There's no interest cost to it. And because of past lending, these countries ran into serious trouble, and we had debt forgiveness initiatives that took place. And these countries cleaned up their balance sheets, and they were back on track. And they were actually doing very, very well because oil and commodity prices rose. They took the lessons to heart and started reforming, and things were looking good. But then they borrowed in the markets as well because they were very anxious to develop their reputation. Many of them went and got ratings from the rating agencies. Some of them even pushed for investment grade ratings. And they borrowed in foreign currency. And you can see what's happening now. Their debt has gone up so much. These red bars, it's the next slide, show you countries that we think are at high risk of financial distress. And among the lower income countries, this is very significant now. It's 50% of those countries are now at high risk of financial distress. So this is something we are quite concerned about. And you may say the absolute levels relative to GDP are still acceptable, but as a percentage of revenues, government revenues, this is creeping up to unsustainable levels. So it's something we're very, very focused on. In terms of what we're trying to do is when we work with our clients, we make sure that the debt that they are taking on from us at least is financially sustainable. And this is a joint program with the IMF where we have what we call a sustainability analysis. And what we're finding here is, again, a change in the landscape. It used to be easy to get all the data that we needed to do this analysis. What we're finding now is there has been sources of credit that are very different from what these countries had in the past. I mentioned market borrowings. Those are traceable. But there's also a lot of private credit as well as credit from other bilateral lenders who are not part of the data capture that we currently have. They lend privately, and those countries that are lending, they themselves have several entities that are lending to these countries. So they themselves don't know how much they have lent these countries. So the issue of debt transparency is something that is quite serious here. I'm frequently faced with countries that are trying to borrow, and we have something called a negative pledge clause that says you should not have pledged any of your revenue or assets to any other country because we are a senior creditor. And when we ask them for information to demonstrate that they've observed that condition, they are not able to do so. And then we go and do our own forensics, and we find that, in fact, there's a massive amount of debt from other sources. And it's not just debt that's not recorded and not visible, it's also been collateralized, which means these countries are pledging some of their assets to the countries from which they are borrowing. And this is potentially very, very serious for the fortunes of these countries, let alone our own lending to them, but even for the countries themselves. So this is an issue that is probably number one that we are dealing with on our client side. In terms of trade, the trade war started, I think, a bit 2017, but has only escalated since then. We had the latest round just yesterday. And this is pretty serious because it's now moved from capital goods to actually going to hit the consumer. And the US consumers really keeps the economy going. And if they are hit, I think this could be quite serious for all of us. You see in this graph the impact it has had on trade volumes already. And we had some projection, but that was based on the assumption that this would be resolved. If it's not resolved and escalates further, this picture could look even worse. And you look at what has happened to China and the US, you see them down sharply in terms of exports and imports from each other. Very, very sharp deceleration. And it is also showing up in FDI flows. The light blue line here shows you the US FDI from China into the US, and that has dropped dramatically. Likewise, US inflows into China. And there could, however, be some bright side to this, and I'll come to that a bit later. And if you look at the impact on bilateral trade within this region, the right-hand side panel shows you China's imports from each of the countries. A very significant amount of trade, clearly, with other countries within the region. You don't need to make pictures. I will have this distributed, if you like. We put all this information out, so it's available. And the other graph shows you as a percentage of the individual countries' exports, how much they export to China. Clearly, for some countries, very, very significant numbers. So this is going to be quite important in terms of impacts. But there is, IFC is our private sector arm, and like all private sector, they look for opportunities. They don't just look at the risk side of things. And they are seeing some opportunities because of substitution effects that are occurring. And what you find is people now saying, well, if I can't export to this country or import from this country, let me shift my business somewhere else. And we are seeing substantial increases in exports, for example, from Vietnam. And likewise for several other countries in the region. And the US is doing the same thing, importing from other countries rather than from China. So you see this effect, which means, of course, corporations have to be extremely nimble and agile and shift. You see this happening also in manufacturing. With all the integration in global value chains, some of the companies are now trying to shift production, and again, Vietnam, Bangladesh, Philippines could be beneficiaries of this. But it is also easier said than done. When they try to shift production, what they find is it's not just labor supply and low wages that matter, but you need the whole package. The infrastructure, the connectivity, the power, skilled labor, ports, and you find most of these other countries just don't offer the same package. So, we shouldn't exaggerate the beneficial effects of this for some countries. They will need to step up. India is a good example. It could have taken advantage of this, but its infrastructure is so bad, and the availability of skilled labor is so bad, the regulation so bad, the business environment just not good enough for it to be able to step into this vacuum. And they've reported extraordinarily low growth rates, but for very different reasons. So overall, our assessment for growth in this region is quite subdued for the region as a whole, but also for the individual countries in this region. And exports will account for a lower proportion of GDP growth than in the past. Now, in terms of other effects, I think on the financial side, there is a heavy reliance on cross-border flows, both in terms of FDI as well as in terms of debt and borrowing. And if financial markets panic or react very strongly to what's happening, you could see some outflows and fairly disruptive effects. I mentioned government debt, but what is also true in this region in particular is a rapid rise in household and corporate debt. And there are some countries where this is a significant source of vulnerability. Also, corporate profitability has been going down. So those corporations that are heavily indebted could have a serious consequences. Sometimes some of the debt is in foreign currency and shorter maturities. So all of this could have effects. The banking and financial sector is actually in better shape financially. I know we're going to talk about some of the soft cultural issues, but on a purely financial basis, this set of numbers here, I won't get into the details, but they just show you the trends in key parameters for the banking sector for many countries in this region. And they've all held up quite well so far. So we don't see any significant financial issues for the banking sector. For Australia, growth is expected to be subdued, and I think the latest numbers, I was looking at them, are quite sobering. And it is reflecting all the global conditions and also domestic consumption. There's a significant relationship with China here, with 35% of Australia's exports going to China. And clearly any slowdown there will have significant effects, but it will also affect trade linkages with other countries in the region. And this to me is very interesting because The Economist a few months ago actually had an article on Australia and its unbroken record for, I think it was 2 decades of very high growth rates. And this may be the first case we are now seeing where that may have to be more sober. That said, I think what we think is the situation in Australia is far, far better than in many other countries that we are worried about. And I'm not talking about our borrowing countries, even among the advanced markets. Australia has diversified its segments quite a bit. It's not as reliant on some of the traditional exports. And there is a high correlation, however, between exports and government revenues. We do see that. But given the diversification, I think we think Australia should be able to tide things over. And the policy stance has been accommodative as well. You see the interest rate cuts, the tax situations, all of these which are expected to stimulate or at least prevent a very sharp reduction in growth. So we're not too worried, and also in terms of FDI flows, most of it is to Europe. So we're not, again, too concerned on that front. So overall, this is a very sobering picture, and I'm not sure what we can all do about this. As I said earlier, this is not traditional risk management. All these relationships are changing, and at the bank, what we try to do is twofold. One is our first and greatest focus is on our clients, and to make sure they can weather these events as best as we can help them. So we do a lot of advisory work for our clients in addition to the financing, and make sure that the borrowing is sustainable, and it's what we call responsible lending, responsible borrowing. So we make sure that's the core of what we do. Also, much of the budgetary financing that we do to governments is linked to reforms. Because as I said earlier, if it's simply used for government spending or for consumption purposes, that is not putting the country on a right trajectory. So we attach most of our lending to very, very specific reforms. And I'll give you an example of Argentina, where as part of the IMF bailout package for Argentina, the World Bank stepped up its own contributions as well. But unlike the IMF, which funds the government directly, what we do is it's linked to actual programs. So we had social inclusion programs, healthcare, education. These kinds of things are helping build the country's foundation for the future. And we also had some very specific investment project loans, which are tied to performance. So that's the way in which we try to make sure our financing is actually going to enhance the productive capacity of the country and not just meet deficits in the government budget financing. That said, I think it's going to be a difficult situation there. The second area in which we focus is trying to meet some of these global challenges. I know the trends are more toward nationalism, but just given our shareholding and given that we were set up to address collective problems, we try to use whatever convening power we have to get people to talk about these solutions. So climate change, other global public goods, migration, we try to bring parties together and say, let's address these issues in the most constructive way. So we're not giving up, even though it may be that certain countries are pulling inward. We think these are, in fact, collective problems, and they have to be addressed collectively. And I will say, for all that's happening in the individual countries, when our board comes together and they meet, they do have their national priorities, but they also see the benefit of this institution. Because it is an easier mechanism for them to use to address some of these problems than doing it on their own. And the best example I can give you of this is the capital increase that we got a couple of years ago. Most people were amazed when we were working on this, and they said, why are you wasting your time? The US actually has the biggest say in this, and you think the US is going to support a capital increase for you. And we did pull that off, which was quite remarkable, with all of the countries negotiating, coming to some compromise. So I'm still hopeful, despite all the troubling signs we see. I think there is hope, and we will continue to work at what we do and try to make the world a better place. So thank you very, very much, and happy to talk some more.
Lakshmi, thank you so much. It's an absolutely fascinating insight into the huge upheaval of our world. Let's have a chat, shall we?
All right.
So,
sit here.
I think what I want to do, I normally sort of start broad brush, but I just want to pick up on particularly what you were saying about Hong Kong, because for our region, it is, the most unstable place, and that, as a cards on the table, girl who was born in Hong Kong under the colonials, had 35 years there, well after the handover. You're absolutely right. It was, this beacon of peace, stability, prosperity. This was something that nobody could have foreseen, and certainly not at this time. But, corporate Hong Kong has now taken an absolutely massive beating from what's going on, shows no signs of ending. So as a CRO, given that nobody predicted this, how do you prepare for the unpreparable, essentially?
So yeah, this is a very good question. I think we all had a blind spot when it came to this specific case. But what you learn from this is political risk is very real. It has been with us through the ages, and we need to go back now to what used to be called scenario planning. And just think about, don't take things for granted in terms of any of the assumptions that we make, but say what could go wrong, or what are the various scenarios that could occur, and what would my response be in those scenarios. So for example, if you take what's happening to Hong Kong now, I think we need to think about what are the possible paths this dynamic could evolve into. There are some which are fairly clear or short term, but then there are longer term ones that we also need to think about. And then any organization working in Hong Kong now needs to think about, given those scenarios, let's say one of them is A, do I want to continue to be operating there under scenario A or not, which goes back to your own values and the kinds of organization you want to be, what your stakeholders expect from you, and your own risk appetite. And then you decide, well, are you going to continue to stay there, or are you going to have some contingency plans? So I'd say the way we need to address this, but also many of the uncertainties I pointed to, is more of generating scenarios of what could happen. Because being prepared is half the trick here. You cannot predict what's going to happen, but you outline all the types of scenarios and what your responses are going to be. And this is something we do as well. We're a bureaucratic organization, but we also realize the world is changing too fast, and we cannot control everything from the center. So we're more and more pushing our organization to be more agile, pushing more power into our country and regional offices so that they can take decisions fast, because they know what's happening and what's evolving on the ground, subject to some broad parameters and, very importantly, certain values that we expect everybody to uphold.
And if we broaden out the Hong Kong conversation now to include China, obviously, because you know, I'm sure most of the people in the room have commercial business interests, you know, in China, and of course, you know, watching what's going on with the US and the trade conflict there, you know, with an eagle eye. There's obviously, you know, a lot of concern, as you know, would be logical. How warranted is that concern, do you think?
Well, I think it is a legitimate concern, certainly not just for countries in this region, but globally. As I pointed out in my remarks here, I think this is going to affect everybody. It's already started affecting everybody. So this is not something we can take lightly. And you know, it's been cast as trade. And trade is certainly one dimension of it, the asymmetry in how things have worked in the past. But it also goes beyond trade. And I didn't mention this, but I think the technology transfer issue is actually a very, very serious one. And it's something some of the countries are only now waking up to. But they realize the current way of operating cannot continue and is not sustainable. So something has to give somewhere. Now, what gives and how it happens depends on how mature and how cooperatively everybody addresses this. And the risk is it degenerates into a competitive you know, race to the bottom, so to speak, versus some sort of virtuous cycle where everybody agrees to maybe a new set of rules on how technology should be transferred, that it can be used for the benefit of all, and it's mutually beneficial. I think that's what some of the countries are really after. They're not against trade, they're not against technology transfer. They want it to be more symmetric, more beneficial to all. And if everybody can work toward that solution, I think we could put ourselves on a better path.